Grant Swartzwelder with OTA Environmental Solutions, and welcome to the latest edition of Oilfield Strong. As you know, this will be recorded and put onto YouTube channel. Invite you to look at all the other presentations that we have. But this one I think will really stand out because it's very timely and it's a fantastic speaker. It's a friend of mine from a long time, Rob Clarke, Vice President of Upstream Research at Wood Mackenzie. Besides being a good Aggie, we've got to lead with that. He actually has experience that is pertinent to all of this, having been with Wood Mackenzie since 2005 and have worked his way up from really kind of the beginning of the research work into now basically taking a leading role in the upstream side. So he is well positioned to discuss with us kind of our topic, which he's done a great piece on acquisition, divestiture, the A&D market, what's kind of happening in consolidation. And so that's the theme today. So welcome, Rob. So let's just start off with kind of that general, what's going on? It seems like everybody's buying everybody up. And are there any other companies left to be bought up?
Yeah. So thanks for having Wood Mac. Thanks for having me, Grant. I've treasured our friendship over the years and look forward to helping out your cool channel here. Gosh, yeah, let me just orient with a couple of numbers, right? So last year, 2023 alone, in just the Permian, just Permian Basin transactions or transactions with Permian Basin assets, that cumulative sum topped $100 billion, right? It's just a staggering number. It's a nice round number that everyone can remember. Obviously, the distribution of that is heavily influenced by the ExxonMobil Pioneer deal. But the kind of fun fact, Grant, is if you take that out, right, 2023 was still going to be a record year of Permian A&D, right? Wow. A lot of assets trading hands. Just to make it a bit current, since we're in March 2024 now, the piece that you referenced, and thanks for doing that, we had a graph in there that showed cumulative spend each year as it kind of builds from 1 January to 31 December. Q1 is pretty quiet typically, right? I guess that's a lot of idea generation and folks working on pitches and relationships being updated. Q1 of this year with the Diamondback Endeavor deal is already higher than the annual totals of some of the other years if you take it all the way to December. So a lot's going on. The numbers are big. And to see Q1 be big this year, we would just offer that there's a lot of momentum in the system. It's really breaking the definition of how each calendar year has gone in the past.
And when you say it's a record year, that's record for the Permian, but it's also kind of worldwide. Permian seems to be one of the most active A&D markets everywhere.
Oh, for sure, for sure. We put out a map. I don't think I shared it with you, and I apologize. I should have. We put out a cool kind of global map every few months that just shows, hey, these are where all the deals are and bubble size for transacted value. To say that the U.S. is really the only liquid asset market in the world is an understatement, right? Because when you look at that map, there's a huge concentration of bubbles all in North America, and then elsewhere it's pretty sporadic. So yeah, safe to say that the A&D banks in the U.S. are probably working a little bit harder than some of the E&P A&D shops elsewhere.
So why do you think that is, that the U.S. and the Permian are kind of leading the charge? Is it? It seems like you had a phrase in your article about the now or never. Is there kind of a feeding frenzy in a way going on that people feel like they have to get bigger in the U.S.
Wow.
in the Permian?
Yeah, I mean that's a huge question. There are some other parts of the world, and I didn't really think the conversation was going to go this way, but I'm happy.
No, I'm not really worried about. And I'm not really worried about the other world as much as just kind of the U.S. and why it's growing. So
sure. I was just going to mention the other part of the world is like there's some interesting stuff going on in the North Sea, but I think outside of that, it might be a reasonable characterization to think that the classical E&P business, there's a view outside the U.S. of a little bit more terminal value risk, right? Energy transition, demand, carbon, potentially carbon prices, all the things that you're super close to at OTA, right? Within the US, maybe that perception of terminal value risk is a little bit less, but you also have a huge number of small companies. And again, to use the word a liquid market, that kind of characterizes the US. So just the mechanics of buyers and sellers coming together is a little bit easier to kind of work through in the US. I don't know if that helps answers the question a little bit on
Well,
that.
to the point about that now or never also, do you sense that people are getting in a feeding frenzy in the US, in the Permian, that we got to have drilling locations? So by God, we need to buy this
Yeah, I
other
mean,
company?
so it's a great question. So some of the deals were done for locations for sure. Other deals were done for maybe slightly different strategic reasons, and I think we might spend a few minutes dedicated to ExxonMobil and Pioneer here in a bit.
Please, yeah.
But there's a plot that we had in the piece that we've used in lots of bits of Wood Mac research, and other folks have done similar plots as well. And it just looks at kind of market multiple, right, on one axis, and then enterprise value on the other axis, right? And you can see better valuations for bigger companies, right? There's a whole host of reasons that we can hypothesize go into that, and some reasons that we know go into that, right? But when you think about kind of the kind of overall, we talk about terminal value risk, just the pressure that some folks believe E&P is under, right? Two words pop to mind to help combat some of those challenges, right? Resiliency and sustainability, right? And those two terms can be thought of in terms of kind of what's your balance sheet and the size of your assets, and how can you withstand a really damaging shock like we saw in 2020, right, or 2015. And then the other piece of that would be like, what's your asset base, and can it compete in the future, right? Can it be low break even, low carbon, right? So you kind of maybe try and orient yourself around sustainability, resiliency. The bigger companies largely do better on those two dimensions, right? So that's kind of an underlying set of reasons that kind of investors might think bigger is a bit better, right? And a lot of that $100 billion I mentioned was public companies saying, hey, we're kind of at this multiple. I wonder if we might get a slightly higher valuation if our EV was much bigger, and we could actually maybe jump from one peer group to another, right? There are a few deals last year that kind of took that. It took a small cap, mid cap, and it kind of pushed them into large cap territory.
And is that, I guess I was going to ask, is that why most of these are a stock for stock deal? I think it also probably has to do with the lack of capital out there, a lot of bank debt, but are they trying to achieve that multiple expansion by taking stock in the larger company?
Yeah, I think that's fair. I mean, the cost of debt's a little bit higher now. Everybody knows that, right? We have had a couple of years of pretty volatile prices, and in some of the stock for stock deals, the argument that's been presented to the market is, hey, this might take a while to close, right? But if we do a stock for stock transaction, depending on how long it takes to close, if there's a big movement in the oil price, that may push both equities in the same direction. So it kind of takes a little bit of that closing uncertainty out of the deal.
Yeah. So back on your point about how there's more value in the larger company, or it's seen that way, flip that around. So if I'm a smaller company, what you're saying is that they should, in a way, be looking to possibly exit or find a way to add value by. So with that, are we done with this A&D kind of frothiness?
I don't think we're finished with it, because the underlying drivers are still the same. I think you and I talking as friends over lunch. I don't think we would turn around and say, gosh, maybe bigger isn't better now, right? There's not a change in the foundation of that, right?
Right.
Why it may slow down is if you were to kind of keep a tally or write down the company names on a big whiteboard in your office. These are desirable targets. These are companies that might be motivated to sell. Like, we could probably put lines through a lot of them, right?
Sure. Yep.
Particularly when you think about the private space, or some big names that seem like it was going to be tough to see them transact, right? Crown Rock / Crown Quest, right? and Endeavor, and both of those companies now have new owners, right? So if you think about constructing a plot of doability, and maybe these companies might be a little bit harder to get something done, and those companies have been involved in a deal, then maybe it does point to it slowing down a little bit. I don't
Well,
think the
then,
$100 billion repeats itself, Grant, right?
yeah, no, well, and it seems this kind of the supply isn't necessarily there of large companies that could, if they're bought by some of these mega companies, it would move the needle. So I would think it would be hard for a Conoco or a Exxon or anyone to find anyone to buy where it would matter to them.
Yeah, there's also a great point of, at some point, you've done really good deals and you've achieved the goal, right? So we had a slide in the paper and the deck that I shared, showing kind of how important the Permian and tight oil is to ExxonMobil now, as an example, right?
Sure.
So if you push your models out to about 2030, end of the decade, roughly 40% of ExxonMobil's global production will come from the Permian. Roughly 40% of value will be in the Permian. That's a lot, right?
Huge.
Particularly for a company that cash flow diversification is really important, and they've done a really good job of managing that in the past, right? So could they do another deal that would have to move the needle? I'm being hypothetical here. The 40 moves to 45, moves to 50. We're just sort of not in that camp, Grant, to think that other deals are required.
Another thing you talked about that interweaves itself into this conversation is kind of remaining inventory versus capital efficiency and how that works together. Would love your thoughts on that.
Yeah. So if this recording goes well and drives some interest, I think it will be cool to get some actual BD folks from E&P teams on maybe a subsequent session to talk about, what the biggest drivers are for them. I can tell you from all the time we try and spend with our clients in industry, one of the thematic points that BD teams are looking to solve for, and they told us this firsthand, is eroding capital efficiency, right? And that sounds a little bit like an oxymoron, because efficient sounds good and eroding sounds bad, but it's the idea of dollar into the system in CapEx. What am I getting for that in terms of production and reserves, right? And as I drill out more of my best stuff and I naturally move up that cost curve, there's a good chance that my wells in the future maybe aren't as great as the wells today, right? And you might think, well, price can bail you out of that for sure, but price goes up, costs go up, right? So there is a fear within BD teams that, gosh, maybe a few years from now, I'm drilling stuff that's quite a bit different with quite a bit higher break even than the stuff I'm drilling today. And by quite a bit, I'm being polite. I'm talking $15 to $20 a barrel break even higher,
Yeah.
right? So how do you solve for that, right? Right.
Well, it seems like the likelihood of that is going to be huge because it seems like folks have drilled the fairway. Now they're breaking out into kind of a little bit more fringe, not all, but more so.
So yes, so this is where I think this conversation actually gets like pretty exciting, right? And kind of makes me think of A&D in kind of the earlier chapters of shale, Grant, where there wasn't consensus on how to drill and complete wells, right? Lots of people were doing lots of different things, and you saw kind of big gaps in asset performance, right? We talk about this a lot. There's a lot of over the fenceism, right? Is kind of a joking way to say it, but there's also a lot of collaboration and really cool stuff that happens at ERTEC and consortia and whatnot, right? So I think over time the sector has done a really good job of sharing what works, right?
Right.
Now, what that means is there's not that much differentiation across assets. Where I'm going or trying to go with all this is, you can look at deals now and say, gosh, well, maybe you're not buying the best sticks, right? Best inventory. Maybe it looks like you paid a lot for that asset. I have the sense that we're not going to be developing acreage the same way in 5 years as we are today, right? I really think some big buyers are coming into the space saying, hey, we got some different tools on how we're going to do this. on how we're going to space wells and sequence wells and how we're going to run diagnostics and the things that we're solving for, NPV per section instead of an IP rate, right? That's a long way of saying, I think some assets that we're looking at now saying, hey, that's a tier 1.5 location. I think that will surprise to the upside in a few years.
Well, isn't there also a capital availability issue? And meaning, it seems like every time a company buys another company, they, instead of having X number of wells and Y number of wells and adding them together, it's always going to be a fewer number of wells that they drill. So the combined entity is not going to drill as much, whether that's capital or whether they're trying to figure out what the right technology is. What's causing that?
Yeah,
Or are you saying that?
Yes, I don't think that's necessarily always the case. I don't think that's the case in this latest kind of slug of A&D. So I mentioned 2021 a few minutes ago. For sure, that was the playbook, right? Two companies together, combined CapEx, knock 30% of it, 30% off of it, right? Slower growth rate, less CapEx. I'm being very wordy saying this, right? But more cash available for shareholders, right? Dividends, buybacks, and stuff. If you really dissect some of the big deals from the last half of last year, you don't really get that message, right? I believe Oxy talked about a small reduction in activity. The Exxon messaging for Pioneer is kind of the sum of the parts, no real pullback.
That's true.
Right?
Yep.
Diamondback Endeavor, there was some guidance towards fewer rigs, but same number of wells because we think we can drill the locations faster because of some of their fluid technologies. So it's a long way of saying, I think some of the deals now are constructed where the buyer's going to do it differently, fingers crossed, signals point to it doing better, not just doing less or instead of doing less.
Okay. Well, that's good news for the service business and for the community then. So
I hope so, yeah.
So the other thing that I think would be good for the industry and for so many folks is that if all these big consolidation plays would spin off that lower 20%, that used to be how the industry, the market would kind of rejuvenate. And there hasn't been that spinoff of, Conoco buying Concho. Yeah, there's been some sales, but I keep hearing on and on how, oh no, the A&D market's coming back. There is about to be a lot of deals out there. And some would say there's a lot of deals out there right now. What are you seeing? What are you hearing? What do you think it's going to be?
Yeah, so some big deals like Oxy, Crown Rock, Oxy did message kind of a pretty big disposal program as part of that transaction, right? I think it's all what size deal are you looking for and how visible is that stuff in the market, right? So
Yes.
I think we had to reschedule this a couple of times. I was in Midland a couple of weeks ago, visited with some folks, and they were quite excited about the number of $50 to $75 million packages that they thought were going to hit the market as an outcome of some of this consolidation, right? So is it big? Is it material for a public company? No. Are onlookers gonna see all of it? Probably not, right? But there's probably a lot of small things that will become available, and maybe it's just bulk blocking and tackling. There's a lot more optimism now on 3-mile laterals and even 4-mile laterals in the Permian, right? That's going to take some swaps and some trades. Is that the kind of stuff we're talking about that's going to come out of this M&A? Like, lots of buyers like to put maps about, look how well the acreage fits together. And that's for sure the case for 80, 90% of it. But what about the other 10%, right? Like, there's still work that can be done. I think that's probably where you have some of that asset recycling in that $50 to $75 million range.
Well, that 50 to 75 range would be perfect for that's kind of right down the sweet spot of private equity or kind of company origination, regeneration, and kind of starting the next generation of little companies out there. It's when it's a 400, $500 million transaction that kind of limits who can be involved in that. So
Yeah.
so that's encouraging that they're talking about doing those smaller sizes. So well, let's go to the other side of the transaction on the larger. We talked about Exxon and Pioneer. Several things there. It's like, I wonder about federal government, it just seems ripe for the federal government to stick their nose in a lot of these transactions. So let's start there. What are you seeing for Exxon, but also Oxy? You know, there's a bunch of deals out there. Seems like they're all being kind of looked at, but to what degree?
Yeah, so they're all being looked at. I don't think we believe any of them are not going to close, right? And I'm talking about the U.S. specific transactions. So
Sure,
we'll
sure.
take the complexities of Exxon and Hess and Chevron and Ghana. We'll settle that aside. We're talking lower 48, right? Um, we think all these transactions will close. They'll just take some extra time, right? There'll be some extra reviews and some extra hoops to go through. I know I've mentioned Oxy a number of times, right? I believe that they have formally pushed back the close date that they've spoken about publicly, right? Um, why is that the case? I mean, gosh, you and I could jawbone about this for a long time about all the reasons why or why not it's more challenging. I can, offer a short story if it's okay. So we talk
Please.
about this a lot with a bunch of our banking clients, and one thing that I've heard, so I'm sort of recycling a bit, but I find it really interesting, um, is I guess linked to what we were talking about a few minutes ago, right? There was a section of M&A a few years ago where pro forma the company was smaller, right? It wasn't investing as much. I shouldn't say smaller, larger production, smaller combined budget, right?
Right.
Um, and some of the headlines around energy policy coming out of Washington the past year, there have been calls for producers to produce a little bit more, right? And I wonder if that is a bit of the sticking point, right? Is there a fear on some of these deals that two companies are going to come together and hypothetically they're going to take $500 million out of the capital budget, right?
Yes.
What could that potentially do to production? But more importantly, what signal would that send the market? What could that do to TI? What could that do to gasoline? We're in an election year. Again, we can hypothesize about this a ton, but this idea of maybe there's a bit of a fear that deals equal lower energy investment, to me, I can kind of make sense of that train of thinking in my head.
See, and what's sad is I hear that, and that almost seems too logical and almost too deep for them to think about the government. In a way, I think it's just more pandering to their Democratic base of trying to hammer on the oil and gas industry. And maybe I'm being a homer for the industry.
No, I mean,
I
I
think,
will, I will leave that to you, my friend. I'm just,
come
I'm,
on, let me pull you into my muck, into my swamp.
I am just trying to connect a few things in my head.
All right. Well, we'll leave it at that. But what the other thing that you hear about Exxon, and I think y'all talked about that, is the importance of integrating Pioneer. And obviously, Exxon did XTO very differently. They've learned from that, but also the importance of how they're going to integrate the Pioneer, not only the manpower, but the assets and what they learn. Speak to that if you would, because found that very interesting.
Yeah, so I'll just touch on it briefly because it's pretty complex and it's pretty exciting, really, when you think
Yeah,
about
it seems like
um
and complicated.
yeah, I mean, when you think about the scale that Exxon will have in the Midland Basin and
Yep.
the history of shale, where basin dominant companies have larger F&D, right? You and I have both seen that, over our decades.
Yes, sir.
Um, the midstream integration, right? The value chain tie up with downstream expansions along the Gulf Coast, the product exports, right? This is attacking shale a new way, where the success of the project is much more complex than just what's my rate of return at the wellhead, right? I think that's really exciting for Exxon. I think the level of technology that they bring to the asset, and Pioneer and Exxon have both openly talked about this. They were different companies with different strengths, right? Um,
And they've talked about
Exxon,
that, but I always thought of Pioneer as being fairly advanced. Now, I guess it's just that Exxon is even more so.
yeah, I mean, just so the size of Exxon's R&D effort, the number of years that they've had tremendous research projects underway in tight rock in the Permian, right? the amount of diagnostics work that they've done over the years, the amount of advanced modeling, and this is next generation modeling stuff, Grant. This isn't what kind of USCMPs were talking about a couple of years ago. The development model they believe they have for the Midland Basin, and Exxon is going to start to talk about this more. It's a value-driven approach, right, to drill more capitally efficient wells and not strand a bunch of wasted capital downhole, right? Which every shale player will tell you has been a problem for a long time, right?
Sure.
Um,
Sure.
Minimizing some of those mistakes through data science. It's capitalizing acreage correctly. It's finding additional opportunities for infill wells, right? There's a big value uplift component that Exxon is chasing by doing things a little bit differently, and I'm optimistic that they'll pull it off.
Do you see anything else kind of coming out of that Exxon Pioneer transaction that will there be sell-off of assets or any other thing that the Midland community, the Permian Basin, other operators will see as a byproduct of that transaction?
Yeah, so I believe there's going to be a lot more said about it after closing from Exxon. What I think everyone's excited to see is just how how intense the development plan is, right? I mean, I mentioned that Exxon's long-term targets is similar to the sum of the parts, right?
Yep.
And if you take Exxon's rig count now and Pioneer's rig count now and put them together, that's a lot of rigs, right?
Huge. Yep.
Um, so how is that leadership in the Midland Basin through size and scale and influence gonna change the landscape for everybody, right? I think that's what folks are eager to learn more and kind of understand where they might have to adapt and react.
Well, Rob, you did not disappoint. I didn't think you would, and always fascinating to hear from you. A wonderful piece of work that you just finished up, and what a timely topic. So, Rob, I really appreciate your time, and look forward to checking back in a few months and seeing how all this came to fruition. So, Rob,
You got
appreciate
it.
you, sir.
You got it. I love talking about this stuff, and I treasure our friendship. And thanks so much for letting me do this. If folks want to reach out, I'm on LinkedIn. I'm on Twitter. We have a good time. We're all in this together. So please connect, learn a little bit more about Wood Mackenzie research through it.
When and you do a great job of communicating through those social media and with some kind of good hot sports opinions. So I think that you're definitely a good follow. So I would agree with your urging of them to do that.
All right. I appreciate it. I appreciate
All
it.
right.
Y'all be good. Stay safe out there.